means you have to change the operator. You cannot fly with the same alliance.
So, Kristen, is it?
One run star lines, it doesn't fit somehow.
Mine is not working.
Oh, this is better, but the resolution not that good.
Doesn't matter, we live with it.
It's not working. They're gonna bring me another one. This is mine, but it's not working.
Okay. Can you see anybody logging in?
Otherwise, I can just.
Yeah, I can.
I just flew only one from New York to Orlando.
If that's the case, you may have to sit here.
Yeah.
So I can. Okay, never mind.
Yeah, we'll see if I can come. If not, if I need to then
We'll see how far I can drag.
Two people is watching now.
Okay, 10.
Oh, four people is watching now.
Okay, 10. Hi. For those watching, we will be starting in just a very short while. Once we get the things organized. Thank you.
Okay. Bye bye.
It's not working. Maybe it's something with the
Never mind. We just click.
joystick. That's so weird. Anyway, let's look at it.
Hi, welcome to our very first task conference. Okay, my name is Lim Yong Seng, and I will be trying to present to you the IFRS 15, or some people call it IFRS 15. This is a standard that will be implemented on the 1st of January 2018. This presentation is, I hope, not going to tell you everything you need to know about IFRS or IFRS 15. In fact, it should raise a lot of questions. Why? Because this is not just a change in standard, it's a change in paradigm. Okay, and effectively, what they're trying to do is basically bring the whole standard on revenue into one standard, and that is the IFRS 15. And because of that, is a change of paradigm from risk to control. Okay, and let me just run through with you. I apologize if the internet is not very good, but we will try as best as possible to speak.
There's something with the computer.
I apologize for that. I think there's some technical issues that we have to resolve once.
It was working fine when I had it over there.
Okay.
Just got frozen. Yeah,
Huh? Yeah, you just and simplify guidance. What's the difference? Okay, this is the revenue recognition model. Okay, FRS is actually a Singapore FRS, which basically talks about revenue and construction contracts. So at the present moment, there are two types of contracts. One is construction contracts, the other one is obligation. And it only separates into two distinct items. One, is this revenue or is this obligation satisfied over time? Or is it settled at a point in time? So there is only two considerations. Is it over time, which is basically then charged on a regular basis, or is there a point in time where you can identify the charging? The old standard focuses on risk and reward of the goods or service pass from the supplier to the customer. Old standard has limited guidance on multiple elements, arrangements, and allowing many interpretations of the standard. The new guidance, there's a lot of separation. That means separating elements, allocating the transaction price. There are variable considerations. They discuss about licensing, time value of money, modifications, and so on. The standard is a bit difficult to read, but encompassing the standard is a set of examples, and in total there's examples in detail, because they give a pretty good explanation of the various situations, and therefore give you better guidance as to how to implement the new standard. What are the areas that will be affected? These will be the areas. So in other words, no matter what business you're doing, if you have some of these in there, you'll be affected. Variable, contingent considerations, time value of money, if your contract is, right? Presentation of returns, are there discounts, rebates, contract modifications, are there contract modifications, licenses, royalties, contract costs, customer specified products, warranties. So in other words, although a lot of the companies will not be affected in a major way, but if you touch on or you have any of these, you will be affected by the new standard. So how does the new standard require us to do? The new standard actually specifies 5 steps for us to follow. And these 5 steps will lead us to a conclusion of how revenue is recognized. Okay? The first step is to identify the contract with customer. Is there a contract with customer? Then step 2 identifies the separate performance obligations. That means that what are you delivering? What are the deliverables that you need to deliver? Step 3 is determining the transaction price. Step 4 then is allocating that transaction price. And step 5 is recognizing the revenue. Okay, and the core principle is revenue is recognized to depict transfer of goods and services. Okay, now it will be very difficult to understand this, so I'm going to give you a simple example just to run through and get warm up on this revenue recognition concept. The simple example, okay, let's say for example, entity A sells product XYZ to customer B. Transaction price is CU18. Condition, 50% upfront, 50% when all 3 are delivered. Standalone price for each item sold separately is CU8M each. So you can see that if sold individually, it is 24 CU, 24 MCU, but as a bundle, they're giving it at 18 million CU. Product X, goods transferred at a point in time. Product Y, good control transferred at the point in time. Product Z, services transferred over a year. Okay? Yeah. So, first, what we want to do is recognize whether a signed contract exists. So, an agreement between, what is a contract? An agreement between 2 or more parties that creates an enforceable right and obligation, not necessarily written. So, you want to check whether there's an approval, whether it's approved, rights of each party identified, payment terms, whether there's commercial substance, and collectability. After you determine that there is a contract, then the next step you want to do is recognize, identify the separate performance obligation. Okay, whether you are able to identify that these are separate performance that can stand alone. So effectively, what is a performance obligation? A promise in a contract with the customer to transfer a good or service to the customer. So there's a separate utility to the customer and separately identifiable. So if they're distinct, it can be not even written, it could be implicit, explicit, written, or verbal. Step 3 is to determine the transaction price. The transaction price is fixed as CU18, right? So in order to determine what is the transaction price, the considerations you need to actually identify is to find out whether there's any variable considerations. Is there non-cash considerations? Is there significant financing component, or is there considerations payable to customers? Okay, so these are all the considerations you need to identify before you deal with it. Next. After you have done that already, then you need to allocate the transaction price. You know that just now, like I said, that if I were to take it on a standalone basis, all three services will be 24 CU24M, right? But as a bundle, we have already agreed that it's CU18M. And because all three can stand alone on its own and can be provided independently, the discount then can be allocated over all three products. So the discount should be then 25%. And the discount for each standalone will end up being CUM. Okay, and how do you determine whether an item could be standalone? You really look at these three items: observable price of goods or services that is sold separately, estimate selling price if not observable. So if it's not observable, you estimate the selling price, then you adjusted market assessment approach or expected cost plus markup approach. And finally, the third one, residual approach. Okay, only when selling price is highly variable and uncertain, then you deal with it, right? So of course, item number 1 is the best, going down. The next step is then to recognize revenue. And what do you mean by recognize revenue? To see whether it is identified over a period of time or at a point in time, right? So you see that in order for you to decide whether it's over a period of time or a point in time, you need to do this consideration. Customer receives benefit or as performed. Another entity would not need to re-perform. So things like cleaning services, shipping services, they are performed once and over a period of time, and it need not be re-performed. If it's yes, then it's over time. Does it create or enhance an asset the customer controls? Like for example, if you build a house on the customer's land, right? It creates or enhances an asset that the customer control. If yes, you can do it over time. Does not create asset with alternative use. That means that you cannot sell it outside except for this purpose. And the right of payment for work to date. That means that whatever you've done to date, you are allowed to recognize it. If it's yes, then it's over time. If it's not, then it will be a point in time. Okay, so as long as you have these three criteria, any of these three criteria, it will be over time. So in other words, next. Okay, the revenue recognition is that first you must determine whether it's over time or not. If not over time, then the default is at the point in time. Revenue recognized when control transfers. Okay, and the indicators for these are when customer has significant risk and rewards, customer have accepted the assets, there's legal title, physical possession, and the right of payment of assets. So this concept is really very different from the previous, okay? A simple example, what if? So that was a simple example, but really, if I were to tell you that that's the end, then it will be very simple. But what if product Y and Z are never sold separately? What if price is contingent on future revenues of customer? What if the customer also receives license to use in the service period? What if payment of products is received upfront? So IFRS will cover all these aspects in the new standard. Okay, now comes a more interesting one. That was the simple, straightforward items that if I were to tell you, it's simple, you can understand it. Now I'm going to run through with you some of the items that will probably raise some questions. Okay, I'm going to go through the same 5 steps and I'm going to discuss some examples. And I hope that after this presentation, you just go and read the examples, because a lot of these things come from the examples that the standard actually provides. Okay, and they can be a bit more contentious. Let's go on to the first one, identifying contract with the customer. Okay, entity C sells land to customer D. C sells land to customer D. D uses the land to construct a housing development. Customer D makes a non-refundable upfront payment of CU 10,000 when legal title is transferred, and CU 990,000 in 5 years, which is when customer D expects to have completed the development. Entity C has no history with the customer, and the land is an area currently not zoned for housing development. Thus, entity C is not able to conclude that customer D will pay more than the upfront payment. If company D fails to pay in 5 years, entity C retakes the legal land and assets. Under our normal circumstances, really what you're going to see is that we're going to just take in this transaction when legal title has passed, right? But not IFRS 15. Why? Because in this case, IFRS looks at the whole contract itself. So one of the aspects that may fail, why? Because one, the place is not zoned for residential. Two, majority of the payment is at the end of 5 years when the development is successful, right? The collectibility criteria is a problem, right? So in this case, it will have failed the IFRS 15 in terms of whether there is a contract and whether that contract, when you record it, is valid in a sense. So what they do is you record the liabilities initially, and on a yearly basis continue to reassess whether a contract with customer is established. Okay, recognize revenue only when the consideration received is non-refundable and when either there's no remaining obligation to transfer goods or services or the contract has been terminated. So in other words, basically you must on a yearly basis, so in other words, in the first year, under these circumstances, under IFRS 15, you will not recognize it as a revenue, as a sale, but recognize it in your balance sheet and every year assess this until you determine that there is certainty that the development will succeed. Like for example, if they get rezoned into housing, or if majority of things have been rezoned and sold. So really, the concept here is now the delay in payment of that revenue or recognition of that revenue until there's certainty that the reversal will not occur. Okay, let's go on to the, okay. So in other words, it says no contract unless customer, okay. How is it different? Okay, clearer guidance to what if entity fails the collectibility test and IFRS actually contains specific guidance on the conduct and modification. Next. Okay. Give you another example. This is a real estate developer enters into contract for the sale of a building. The contract is CU 1 million. Non-refundable deposits, he obtained 50,000. Non-recourse financing, that means that the developer is financing the purchaser. Right? Arrangement for the remaining 950,000. If customer defaults, the entity can get further compensation. Okay. What is the customer? Customer plans to open a restaurant in the building. He has little experience in the restaurant industry and high competition in the restaurant industry. So under these circumstances, how will you really do it? Okay. In our old system, we will have recognized two transactions, right? We will recognize when the title is past the sale of the product. We will also have recognized that there's a loan element. But in this case, under IFRS 15, criteria not met. Why? Because of major risk. So revenue is not recognized for a contract that does not meet the scoping criteria. And any consideration received is recognized as liability until either entity has no remaining performance obligation to transfer goods or services to customer, and all its considerations is received and non-refundable, or contract is cancelled and amount received are non-refundable, or the scoping criteria is subsequently met. Yeah. So really, you were to see, even in identifying the contract, it is already very different. And that allows basically the auditor, the accountant to really look at the contract and say, was there a contract? And passing of title, okay, transferring of title of land, transferring of title of goods may not constitute conclusion of the sale. Okay, the second one, identifying performance obligation. Let me give you another example. Entity E enters into contract with customer F to construct a brand new high-end power station. Control for the power station is expected to transfer at the end of 5 years. It is the first power station of this particular design, and Entity E agrees to provide support for to customer F in connection with the general maintenance of the plant for the first year of operations free of charge. Entity E also provides similar maintenance to other power stations. So you ask yourself, how many performance obligations are there? Okay, and as far as performance obligation, it means distinct obligations to do. Okay, under normal, you will think that this is it will be. Go next, huh? Next. Okay, so what is separate performance obligations? Well, individual distinct goods are sold separately or can be used separately. Right. Consumer goods are examples. Goods with simple installation or mobile service. Right. The second group is a group of integrated goods. That is, like, for example, when you are doing implementation of computer construction contracts, they're dependent on or interrelated with other items in the contract. And then the third one is series of homogeneous services. Okay, they are homogeneous and consistent pattern of transfer over time. Okay, they could be like cleaning services, ferrying services, and call centers. Okay. So, what are the factors that indicate goods and services is separate and identifiable include entity that does not provide a significant service. That means that there's a significant service of integrating the goods and services, right? Or goods and services does not significantly modify or customize another good or services, or goods or services is not highly dependent or highly interrelated. So if you look at the examples that I gave you, next one, you will probably identify that wrong one. Yeah. You will probably identify that as far as this is concerned, the services are okay. So with that criteria, let's come back to this thing called bundled products. Okay. So in this example, a company licenses network management software to customer with an upfront fee of 2 million, including a 6 months maintenance contract of 200,000. The company communicates plans for development of additional free upgrade, not available at delivery, but available 6 months. The upgrade is not dependent on interrelated with other items in the contract. So usually, under our normal circumstances, we'll identify, okay, there's a software and there's a maintenance. So you split it into 2 contracts. You take 1.8 million because the 6 months maintenance is 200,000. You take the 200,000 and you allocate it over 6 months. And you take 1.8 million as the software contract. What will change using the new standard? In the new standard, you identify everything. That means that you do not allow any service that you provide to be left out of the identification. So in this case, you will identify not just 2 contracts, but 4 contracts. One is the software license that's being sold. 2 is installation. 3 is the software update that you promised. And 4 is the technical support. So really in this case, what you have seen is instead of the 2 services or 2 contracts that we usually will have accounted for ourselves, in this case, you have identified 4 different contracts or 4 different standalone contracts. Okay, next. However, if this is a very customized software, then you could have just 3 services because software license and installation cannot be separated. So the same case as the previous one, except that the rate below, okay, by identifying that the software license cannot be separated from installation because the installation requires a lot of customization, you end up with 3 contracts. Okay. And in this case, like what it does is that if a manufacturer historically gives maintenance to the end customer, right, it need not have really whether there's a contract or not, it doesn't matter. It really depends on whether it's a custom or expectation or what has been highlighted to the supplier. What are bundled contracts? Okay, bundled contracts will be some things like this, where you have customer loyalty programs, extended warranties, renewal options, materials, Okay. What you want to then look at it is there a material right? If there's a material right to a certain item, then you must try to identify the standalone price of the option and allocate a portion of the sale price to that option. Okay. Alright, the next one is basically on POs. Construction company contains contracts with developer to build 100 houses on the developer's land for CU1 million. All houses are constructed based on one of 3 designs provided by the developer. Developer manages the overall development, including other contracts on site for the plumbing, electrical, and other infrastructure. Okay. So then in this case, you identify whether there's 1 PO or multiple POs. Okay. Does it matter? It doesn't matter really very much until you start doing some modification. Like for example, what happens if 10 more houses are added? Okay, how would you then treat it? So there are actually three options here. How you want to account for it is if they are separate. That means that, like, for example, the modification adds additional distinct performance priced at the standalone selling price. That means that really, if I were to construct 100 houses at the same price, and I just add another 10 more houses and their market price, then it could be a new contract, right? At modification date, okay, so just go on to the next one, right? So if each house is a separate performance obligation, then if I add 10 new houses, right, and they are already at standalone prices, then really it's only a new contract and you don't even look at the old contract. Next one. If the 10 houses are sold below market value, but because you are able to separate each house from the contract, right, and you've already, let's say for example, you've already completed 50 houses today, you can actually then identify this and say, okay, they've been sold below, and these are multiple contracts, multiple POs. I add the other 10 houses to the remaining 50, and then I will then take the total cost and divide by the cost, and that will be the cost per book item. However, if you consider the whole item as one PO, right, then you're considering it as not distinctive. And if it's not distinctive, what you do is that you take the cost of the 10 houses, which are sold below market value, add it to the 100, okay, divide by 110 and multiply by the number of houses that has been completed. Right? So you can see that just by identifying whether there's multiple POs or just one PO, the treatment of how you cost your house is already different. Okay, next one. Okay, so contract modifications will include not only construction, the communications, power, utilities, outsource, technology, and the rest. Next one. What are the challenges? Okay. The performance obligations actually is the building blocks for this model. So we need to assess, okay, where and what are the performance obligations. So in other words, you're not looking at a full contract, but each of your full contract you identify it into what obligations are you supposed to be preparing. And each performance obligation becomes something you need to think about and consider. And then assess the perspective from the perspective of the customer, and there will be significant judgment required, as to how you're going to split these few performance obligation, right? And you look at the rights of the customer. Transitionally, you need your better IT system. Sales need to understand the sales pitch to customers. You don't over-promise. As long as you say, oh, I'll provide you 6 months free service, that simple promise will end up being, okay, a reduction of revenue. So in other words, how your salespeople tell the customer, and it need not be a contract. I can verbally tell you, don't worry. You buy this product, if there's any problem, I will service it for the next year. No contract, but if it's something that your salespeople continually tell people, then you have to identify it as a separate service that you provide, and therefore have to allocate revenue for the work that you end up doing. Okay. Other consideration like compensation plans and messaging to investors. Okay, so that is actually step 2, and now we come to step 3, determining transaction price. This is even worse. in the sense that now our revenue may not be what you see in your invoice. So therefore, sometimes you are seeing that in the next year, you cannot tie in what you record to IRAS or your tax department for GST or VAT as compared to the revenue in your financial statements, because they will no longer tie with each other. Okay, let me just run through a few things like this. Assuming it's same case, that's a power station. The contract price is CU 1 million plus 5% bonus if the plant meets specific operating threshold in the first 2 years. Entity E projects a 50% chance that it will receive the bonus. Okay, and 50% it will not receive. The plant is a new design and Entity E has limited historical evidence on the plant's operations. Customer F finances the project by making a CU $1 million prepayment for the before the construction begins. Lending rate is 10%. So you can see that at the end of the day, that CU 1 million that you initially pay is not just for the cost of construction. Firstly, there's this 5% bonus, and you say, okay, I'm going to get the 5% bonus. There's a 50% chance. You must assess what is the possibility of you receiving it. So in other words, really at the end of the day, the contract price is not 1 million, but your expectation of how much you're going to get above that 1 million. Two is that the CU 1 million is no longer just the purchase of the building or the construction of the building. There's two elements in it. One is the loan, the financing of the construction of the building and the cost of the building. And these two needs to be separated and identified. Okay? In the old standard, you don't. Financing is not in this picture, and you just take it as a prepayment, do the construction, and charge 1 million to revenue. Now, you have to allocate it into these different things. Okay? So, what is the difference now here? You see that in the old system, variable considerations need to be measured reliably. Sufficient advance that performance is probable to meet. Okay? Whereas the new standard says highly probable, not subject to significant reversal. That means that if you think that you can get it, you can include it in as revenue. For financing, prepayment is not a financial liability. Time value of money is considered only for deferred payment. So in other words, you don't even consider it as a financing arrangement. IRS to determine if significant financing component exists. Okay, and so if you use IFRS 15, then you must do the transaction price adjusted for time value of money if there's a significant financing component. Alright. And variable consideration include only if highly probable that they will not be reversed. How is this different? Okay, time value is considered upfront in both directions, and there's clearer guidance. Okay, as a general practice, no adjustment in time value if it is within 1 year or less. Okay, include financing implicit in advance payments is significant. Reason for time difference. Okay, intention of parties. So sometimes it can be long, but the intention of party is not financing, then you do not include it. So really at the end of the day, the financial controller then plays a big part. He needs to decide if something is more than 1 year, whether that is a financing activity or is a strategy. If it's a strategy, he must explain that that's a strategy and therefore there's no time value of money. If it is not, then he must identify that there's a time value of money. Okay. Like for example, in this case, advance payment. Contract to provide technology support for 3 years. Consideration is CU 300. Payment terms required to pay upfront. Purpose of the payment terms: minimize the chance of customer walking away, reduce administrative costs for renewal and payment. So is there a financial component upfront? Then you need a question, and really you need some answers from the financial controller. Okay, like for example, in this case, you see that the implicit interest is 34.9%, then there is definitely a financial what we call component in it. Okay, next. So what is variable? Your considerations, you are looking at discounts, price concessions, rebates, refunds, performance bonus, penalties, sales, okay, incentives. Estimate is based on the expected value and most likely amount. Okay, I will give you some examples of that. Okay, yeah. You use expected value, okay, yeah. Include in the transaction price only if highly probable that there will not be a significant revenue reversal. Okay, yeah. And the key item is that you must recognize minimum amount, highly probable of not recovering. Reassess the end of each reporting period. Okay. So what is variable? Entity sells machinery for CU 100M with up to 5% bonus based on meeting future efficiency targets over 5 years. No similar contracts. Customers' behavior affects efficiency. History shows range anywhere from 0 to 5%. So what is the amount of revenue that should be recognized? If you say 0 to 5%, well, you can't use A because it's 100 million and they will get some performance bonus. You can't use C because that's the maximum and you want to look at the most probable. So what is the right answer? The right answer should be B. Okay, and so the client, the company will recognize 101 million. That 1 million, the 1M is something new and something that they will have to take up based on the estimate basis. Next. Another example. Entity sells machinery for C100M with up to 5% bonus based on the meeting. Okay, has similar contracts with the range, but now expects it, 95% of it is between 3 to 4%. So in this case, just like in the previous case, you don't take 100M because there's a minimum amount. You don't take 105M because there's a maximum amount. You take what is the most probable, which is 103M. Okay, the 3M, again, just plucked out from. So estimating the contract revenue, okay, basically you look at what is the promise to deliver, okay, performance obligation over time. So if it's promise consideration, it could be fixed consideration, variable consideration, right? Or it could be most likely. So in other words, sometimes some of these could be most likely. Like for example, in this case again, variable considerations. Most of the time you go to coffee shops, I'm not sure, like Starbucks and stuff like that, you give a card, they chop, they just chop. On your 10th cup, you can get a free. So how do you value it? So now, if they say 1 cup of coffee is equal to $5, 10 cups, they sell you the card at $4.50. How much revenue? This card is valid for 1 month. Right? And if you have a statistics, and the statistics show that 80% of customers will get their 10th cup. Only 80%, not 100%. What should be the revenue? Okay, $5, which is something that you won't get because essentially a lot of people will redeem their 10th cup. $4.50, okay, that will be too little, right? Because you know that people will. So the right answer should be $4.60. Okay, because people will redeem, and 80% of them will redeem, and therefore when you really calculate the cost, it becomes 460. So you can see that as far as this is concerned, the concept of invoice is equal to revenue is no longer there. You're moving away from whatever you invoice is the revenue you recognize, but rather to be able to identify the services and what you have. Okay, contract revenue, non-cash considerations, very simple. They use fair value and you just take in the fair value. Next. This is another issue. Sometimes we actually pay our customers, like for example, if you are going to a big departmental store, you may have to pay the departmental stores for renovating your section of things, right? Under the old system, you will just take this as expenses and forget about it. And then after that, the rest is income. But in the new standard, okay, you need to consider, let's say for example, consideration for selling 100 phones, $100,000. Payment to retailer for advertising services, let's say 10,000. You need to do one more step. That means that you need to do a fair valuing of the advertising service. And you feel that the advertising service is 8,000, then the excess of the 10,000 you pay, the 2,000 is the excess. What do you do with the excess? You reduce your revenue. So in other words, now you're even charging some of your expenses back into revenue to reduce your revenue. Okay? And in this case, you can see that if your fair value for advertising services is 12,000, you will take the 10,000. However, if it's 10,000, it's okay, but on the right column, if it's 8,000, you actually then reduce your service. You will then take that 2,000 and reduce your income. Who else will be affected? I think nearly everyone. Next. So what are the accounting challenges for this category? It's a new model. Okay? It requires assessment of the minimum, and estimate required judgment, okay, and require better disclosure. In other words, basically for the auditors, a lot of more disclosures will actually come out into this area. Okay, controls process needs to be enhanced. You know, compensation plans will they ever match? They will no longer match. Communication to investors about changes to timing of recognition. So in other words, there is that change in recognition. Okay. Item number 4, then you do allocating of transaction price. Okay. So having said that, you have already done your best estimate of the pricing and what you determine as the price. Now you need to allocate it. Okay, I'll give you this example. Entity G sells mobile phones, tablets, and airtime plans to customers. Entity G offers a new promotion package where customers can purchase a phone, subscribe for a 12-month airtime plan, and receive a free tablet for CU 800. This reflects a 20% discount on the standalone price. Right? Phone is CU 300, airtime CU 300, tablet CU 400. So altogether 1,000, but you're only selling it for 800. The entity regularly offers bundled packages for the phone and a 12-month airtime for CU 400. How do we treat this discount? Next page. Okay. Instead of just trying to allocate, right, in the first instance, equally to everyone, because there is already a bundle, and that bundle puts the phone and airtime together, although their CU 600 is sold as CU 400. Okay? You can take that together and say, okay, the tablet will be valued at CU 400, the phone and airtime is valued at CU 400 as well, and therefore the discount will only be relating to the phone and the airtime. So in terms of allocation, you allocate transaction price to separate POs based on amounts expected to be entitled for each PO. Allocate based on relative standalone selling price. Observable price of goods and services that are sold separately. And use possible estimates. Expect cost plus reasonable margin, market prices of similar goods or services, or residual approach. Okay. The old system, residual approach is very limited. Okay. Yeah. Next is allocating. Okay, here is a different thing. This is where a lot of phone companies are doing. A customer enters into an internet broadband contract with 24 months contract. Term and receives a Wi-Fi router for $100. For telephone and internet access, okay, the customer pays $50 a month. If the Wi-Fi router was sold separately, the company would have charged $300. So in other words, the router is charged at $100. Under normal circumstances in our accounting, what we'll do is we'll take the $100, charge it off as capital, put it into fixed assets, right? Or charge it off to expenses. Wait, no. Go back. Just now. No, I want. Yes. Alright, you charge it off as expenses, right? However, in this case, under IFRS 15, you must properly allocate. So in other words, what you're saying is that your broadband service is overpriced and your Wi-Fi router is underpriced. The company, at the end of the day, will charge you $1,300, being $100 for router, $1,200 for the broadband. So altogether, $1,300. But if you were to take a standalone selling price, it's $300 and $1,200. Altogether, $1,500. Therefore, you must properly reallocate this. And so your Wi-Fi router will end up being $260. Your broadband service will then be reduced to $1,040, and your total price will still be $1,300, right? But you will treat the Wi-Fi router as being sold at $260 and recognize the revenue immediately. Okay, whereas the broadband services, you only allocate $1,040 and allocate over 12 months. Next. So you can, okay. So the next step 5 is recognize revenue as and when promise to transfer of goods and services is satisfied. Okay. Entity H agrees to produce 10,000 car frames for customer for a transaction price of CU 10 million. Entity H has a right to payment for work performed, including reasonable margin, if customer cancels while the production is partially completed. There's no alternative use of this. Okay, how is revenue recognized? So under these circumstances, you're saying, okay, Entity H agrees to produce 10,000 car frames. Right? It has a right of payment for work performed, including reasonable margin if customer I cancels while the production is partially completed. There's no alternative use of the frames as they reflect a particular car model designed by the customer. Next. Is this at a point in time or over time? Right? You will see that you have to do this consideration, right? Does the customer receive benefits, okay, and need not perform? Create an enhanced customer asset, or does it create an asset with alternative use? If any of this is breached, then it is over time. If not, then it will be at a point in time according to the bottom. Okay, and you will see that actually under such circumstances you are allowed to account for it over time. That means that essentially is that even if the customer tells you hold these products, I'm not taking delivery, because it is done over time, Whilst I'm manufacturing and putting it in my warehouse, I can actually start recognizing revenue because it's revenue over time and not revenue at the point in time. Okay? And if the top is not failed, then if criteria is not met, then it will transfer at a point in time based on one of these criteria: right of payment of assets, legal title, customer acceptance, physical assets, and customer significant. So really, at the end of the day, once you determine there is a point in time, then what is a reasonable point in time for you? Okay? So only two considerations: satisfied over time or point in time. Okay? Next, these are the considerations that you need. I've already stated it earlier. Yeah. Next. So the consideration is always, if not over time, then it is by default a point in time. Okay. So are all construction contracts in the scope of FRS 11 accounted over time under the guidance? It may not all be the case. Some of them could be a point in time. Next. Okay, if it is over time, it must have both no alternative use and right to payment of performance to date. Okay, that means that entity is unable to contractually or practically to direct it to another use or compensate for performance. Okay. Alright, this is just another example of that. Okay, next, go on. Okay. These are just examples of it. I think that more or less I've already discussed with you. Just go to them. Okay, what are the points you need to consider for this? Okay, the accounting challenge. This is a new model. Okay, and some traditional goods might be seen as manufacturing services. Judgment required to determine if right to payment exists. Right. And transition challenges systems to measure progress when services perform. Sales and legal, do they understand the implication of these contracts? And compensation plans, do they match revenue? Okay, I thank you very much, but effectively, I hope that I've not really told you so much that you will not go and look at the standard. In fact, actually, this is not trying to teach you what IFRS 15 is about. It is to bring your awareness that come 1st January 2018, your concept and paradigm of what is revenue will be completely changed, and it is the right time now for you to start looking at it. There are multiple examples in IFRS 15, or you call it IFRS 15. There. I think it needs a deeper look. Why? Because what you traditionally think is revenue, what you traditionally believe and book in as revenue, what the accounting staff record as revenue may not and may no longer be revenue. In these examples, what I was trying to run through, and I know that it's dry, is to show you that revenue is no longer what you invoice. Revenue is a totally different concept. Change in control, different mind concepts. And unless you practice it and think about it well enough, you will end up falling into the old paradigm and making the mistake of using the old standard when this new standard comes into effect. Okay, so I would like to thank you for your time and for listening in to this presentation. Thank you. Okay.
Good job. So this
Well,
is done?
Done.
Recorded properly?
Don't know. I will have to see.
Have you saw the calendar?
We spoke for faster than thought. Yeah, done the 2 hours.
Well, because You didn't go through every single exam because it gets to you connected that, disconnected it.
Yes.
Okay, see you then.
Yeah. Never mind. I just close.